In the early 2000s, America had a fever, and the only prescription was owning a two-car garage. After the dot-com bubble burst and 9/11 shook the world, the Federal Reserve, led by Alan Greenspan, decided the best way to calm everyone down was to make money ridiculously cheap. The Fed funds rate was slashed from over 6% down to a mere 1%. This turned borrowing money into a national pastime. The prevailing wisdom was simple: buy a house. Any house. It didn't matter if it was made of sticks and hope, because real estate only ever goes up, right? This wasn't just an investment strategy, it was practically a patriotic duty. The American dream was no longer about a stable life. It was about leveraging your entire existence on the belief that your home's value would shoot to the moon. So, with millions of new mortgages being signed, Wall Street had an epiphany. Why should local banks hold on to these boring loans for 30 years? That's so inefficient. Instead, they invented a brilliant product, the mortgage-backed security, or MBS. Think of it as a financial smoothie. Investment banks bought up thousands of individual mortgages, threw them into a giant blender, and packaged the resulting sludge into bonds to sell to investors. Some parts, the tranches, were supposedly safe, filled with good borrowers. Others were less so. Then they took the riskiest leftover pulp from these smoothies and blended them again into something called a collateralized debt obligation, or CDO. It's the financial equivalent of a hot dog. You don't want to know what's in it, but someone convinced you it was delicious. The machine needed more mortgages to blend. The supply of responsible people with good credit was, unfortunately, finite. So, lenders got creative. They pioneered the subprime mortgage, designed for people with credit scores that would typically make a loan officer laugh and call security. We got stated income loans, affectionately known as liar loans, where you could just invent your income. No one checked. This culminated in the legendary ninja loan. No income, no job, or assets. You could literally be a professional couch sitter and get a mortgage for $500,000. The brokers on the ground didn't care. They got their commission up front and immediately sold the loan to Wall Street. The risk was now somebody else's problem, a very, very distant somebody else. Now, you might think investors would be hesitant to buy these smoothies made of lies and impending defaults. And you'd be wrong. Because the whole system had official referees, the credit rating agencies. Moody's, Standard & Poor's, and Fitch were paid to evaluate these complex securities and give them a grade. A AAA rating was the gold standard, meaning it was supposedly as safe as a U.S. government bond. The problem? The investment banks creating the toxic CDOs were the ones paying the agencies for the ratings. It's like letting a student grade their own homework after they've slipped you a $1,000 bill. Unsurprisingly, thousands of these securities, stuffed with ninja loans, got a perfect AAA rating. It was all perfectly safe. Officially. With all this supposed safe debt floating around, Wall Street invented yet another product, because of course they did. It was called a credit default swap, or CDS. In simple terms, it was an insurance policy on a bond or an MBS. If the bond failed, the insurer paid you. But here's the twist: you didn't need to own the thing you were insuring. This is like buying fire insurance on your neighbor's house. You're not protecting yourself, you're actively betting it will burn down. The biggest seller of this insurance was the giant AIG. Their London office sold hundreds of billions of dollars worth of CDS protection, collecting premiums and assuming they'd never have to pay out. After all, a nationwide housing collapse was impossible. It had never happened before. What could go wrong? By 2006, the music was starting to get a little weird. The endless climb of housing prices finally sputtered and stopped. This was a catastrophic problem for a system built on the idea that you could always refinance your way out of trouble. Suddenly, you couldn't. At the same time, all those creative, adjustable rate mortgages started to adjust. The low teaser rates expired, and monthly payments for subprime borrowers doubled or even tripled overnight. People who could barely afford the first payment were now facing an impossible bill. Delinquency started to rise. Then, foreclosures. It wasn't a flood yet. It was just a few dark spots on the ceiling. The kind you tell yourself is probably nothing to worry about. The first major player to face the music was Bear Stearns, the fifth largest investment bank in the country. In the summer of 2007, two of their hedge funds that were heavily invested in subprime MBS collapsed completely. For months, the company insisted everything was fine. Then, in March 2008, it wasn't. Over a single weekend, the firm evaporated. Worried about a chain reaction, the Federal Reserve stepped in and brokered a fire sale to J.P. Morgan Chase. They bought Bear Stearns for $2 per share. A year earlier, it was trading at over $150. This moment gave us one of history's greatest examples of dramatic irony, when TV personality Jim Cramer screamed at his audience a few days prior that Bear Stearns was fine. Apparently, it was not. The government saved Bear Stearns, which created a sense that there was a safety net. Surely they wouldn't let another massive bank fail. Well, meet Lehman Brothers. They were even more exposed to the collapsing housing market. As their situation worsened through 2008, everyone in Washington, D.C. watched. Treasury Secretary Hank Paulson, a former CEO of Goldman Sachs, decided to teach the market a lesson about moral hazard. He drew a line in the sand. No bailout. On Monday, September 15, 2008, Lehman Brothers filed for the largest bankruptcy in U.S. history. This was not a domino. This was the asteroid hitting the planet. The global credit markets, the plumbing of the entire world economy, seized up instantly. The lesson was learned. Sometimes the moral of the story is that you've just destroyed everything. With the world economy in a nosedive, the no more bailouts policy lasted about 48 hours. The very next domino was AIG. Thanks to all those credit default swaps they sold without collateral, AIG's collapse wouldn't just be a bankruptcy, it would detonate the balance sheets of nearly every major bank on Earth. They were, in the now infamous phrase, too big to fail. So the same government that let Lehman die gave AIG an $85 billion loan, a figure that would eventually climb to over $180 billion. Then came the main event, the Troubled Asset Relief Program, or TARP, a $700 billion blank check for the Treasury to pump directly into the banking system. It was the ultimate irony, using public money to save the private institutions that had gambled the world away. The immediate result was the Great Recession, the worst economic downturn since the Great Depression. Millions of people lost their jobs. Millions lost their homes. The global economy was shattered. In response, governments passed new regulations, like the Dodd-Frank Act in the U.S. It was designed to rein in Wall Street and prevent a sequel. Did it work? Well, the banks at the center of the crisis are now bigger than they were in 2008. The complex financial instruments still exist, just with different, more boring names. The fundamental lesson seems to be that humans are exceptionally good at building intricate systems on faulty assumptions, acting shocked when they explode, and then carefully rebuilding them with the same basic flaws. It's a tradition. If you enjoyed this video, please like, comment, and subscribe to our channel for more historical insights. Thanks for watching, nerds!